Let's talk some charts. Kevin Green joins me this morning, our senior markets correspondent, looking at the levels that matter here. KG, good to see you again, sir. So it looks like S&Ps continue to struggle to really get past this 61 level. Tell me what you see on the charts.
Yeah, so if we're going on the daily chart, we've been tracking this over the last week and a half here, Oliver, where we have actually a new channel that has formed. And actually, I believe you kind of talked about this or alluded to this on Risk Radar yesterday evening here. But we're in this downward channel. We're making lower highs and for the most part, lower lows if you're looking at the last 2 weeks here. But this is still ultimately healthy. It's still in the bull's core right now for them to try to break out of this. And we're going to be potentially touching the 20-period moving average here, which is sitting at around 60.30. You want to be able to touch that, maybe even touch the 50, which is sitting right there at 6,000, and then try to break out of this channel, then break through 6,100. That would be the ideal thing to actually happen here. But unfortunately, you are seeing some pressure when it comes to the markets, right? We still have this rotation trade taking place. This morning, it's more defensive in nature. Consumer staples doing fairly well. Technology getting hit a little bit, but there is some bright spots under technology when you're looking at Apple. So we still have 5,900 as our major negative gamma area. There is a spot at 6,000 that we have to be mindful of, obviously, and there's a lot of confluence there when it comes to those moving averages. Ideally, you want to be able to hold that 6,000, try to break higher here, especially if we have the inflationary data tomorrow that comes in better than the street's expectations. To the upside, 6,100 is going to definitely be your key area of resistance over the next couple of days. Obviously, it's been a pretty decent area of resistance, but the technicals for the most part this year have been holding up pretty well. And on an intraday basis, what do we need to do? We need to recover 60.50. And if we can push higher, you're looking at 60.90 as your kind of your area of resistance, your pressure area, 10 points away from 6,100, rightfully so. Any type of breakdown, 60.25, you want to be able to hold 6,000 is going to be your next level here. Let's see how this 5-minute candle actually closes, because if this does close as a hammer candle, a green hammer candle, that's exactly how you want to actually start off the day, because that's where you got to get a little bit of recovery. You get some buyers to really step in. Not a lot of economic data on the calendar, but we do have Chairman Powell speaking. And we also have some other Fed members speaking. So holding pattern for now. Bulls still have the edge, no major breakdowns, but unfortunately, I think it's been a little bit more of a challenge than a lot of bulls and market technicians would have liked to see, with us trying to just, ramp up and just break through 6,100 and try to capture 62.
So that little candle we got there so far is a hammer candle, is that right? Or we got to see how we close up, obviously, but so far.
Trying. Yeah, so far, but it's trying. So, and you would like to actually see that hammer candle, let us close actually right there at the highs of it, a full body, hammer candle there. That means that we just had some selling pressure to start off the day. We had some buyers kind of stepping in, and that's usually a candle signal that some buyers really like to buy dips on, no matter what the time frame is. And the larger the time frame, right, a daily chart, or if you're looking at a 15-minute, the more weight a hammer candle carries. This is a 5-minute, so obviously it's not going to have as much weight as, let's say, a 4-hour or a daily candle, hammer style candle, but it's something to be mindful of as we kind of start the day off. And actually, some of our more successful days, Ollie, have been flushes in the morning and then rally and recover throughout the afternoon. You don't really want to start off the day too much in the green, because it gives more reasons for individuals to try to sell assets rather than buy them.
That's kind of what I was thinking too at the opening bells. If you're looking for little dips, they've generally been bought, even though we haven't broken out. We've still been buying the dips and hovering within the range, especially when it's the Russell that's dipping too. It's kind of the least important one. No offense to the small caps, but with bonds selling off too, you kind of expect the Russell to start off a little soft. So we got Alphabet turning green, Nvidia turning green, Apple with a nice little bid, which seems to catch a bid on days where we do start a little bit off for some of the big Mag 7. All right, so we're looking for a full body hammer candle. Love that. Full body lines, full body candles, two things I love. Take me through the intraday real quick, KG. Or is that the 4-day one we were just looking at, or you got one even zoomed in more?
Yeah, no, this is the intraday one that we're looking in. And my apologies, it's a 15-minute candle, so it's gonna so what's 45 past the hour. That's really when we're gonna get that to close there. But it looks pretty decent right now. So once again, what do you want to do? You want to break above? You want to recapture 60.50? You want to break above that? We actually had this range where we had an area of resistance yesterday sitting at around 60.70. I would say on a technical basis that probably will be a test area, come back, maybe retest 10 points lower, and then try to push higher. That would be ideal. Any fundamental breakdown, especially at this level right now, 60.45, 60.40, once again, you're looking at around 60.25 as your first area of really true support. Any further breakdown, 6,000, and that would be your pen risk for today.
Great.
And you want to actually see the interesting thing is that volume for index options over the last couple of trading sessions have been relatively light. So we're not seeing these massive areas where we have 3 or 4 contracts that have over 100,000 contracts being traded. It's usually only just one.
That to me seems like on the very margin, maybe a bit of a negative strike, possibly just because when we get a lot of options activity, it seems like lately there's been a bullish bias for that. That's kind of my small 2 cents there. I want to talk commodities with you, KG, real quick, because a couple interesting moves. The big breakout in gold, but then also a bit of a turnaround in crude, firming up and following through today. So run us through those real fast.
Yeah, so I'm keeping my eye out on this for the rest of the week here, Oliver. The gold trade, what I find very interesting, and I think it provides a lot of our viewers a little bit more color, but actually what's happening here since January 24th, we've seen this nice little run to the upside. Obviously, this is a bull trend. I also have, a 100-period moving average or 100-day moving average on this as well. You can see that as a nice area of support. But since the 24th, up until yesterday, we only had 2 trading sessions. So that's out of 11 trading sessions. 9 of the 11, we actually saw open interest going lower as prices are going higher. What's happening with gold right now is the physical delivery that's happening with the February contract that's actually pushing prices higher. Producers, or these hedgers, if you will, the JP Morgans of the world, the Deutsche Banks of the world, they're actually trying to get physical gold and get those delivered to their customers. There's only around a 12,000, give or take, contract difference between what they're delivering to their customers for settlement and what they're actually holding on their books, if you're looking at the totality of this whole thing. Why do I bring this up? Usually that's not the behavior of a continued trend to the upside. Usually that's late cycle. And if you're looking at the managed money flows, a lot of the bull action right now, a lot of those that are buying are ETFs and retail traders. And unfortunately, when you're looking at commodity cycles as a whole, that's usually once we kind of get closer to an end of a trend rather than a beginning of a trend. What's also very interesting, the front contract right now, the active contracts in April, we won't be able to have any of these delivery notices or these assignments taking place until first notice day. And first notice day is not going to be for another 2 weeks. So a lot of this delivery type of action that we've seen, which has been very aggressive, is going to subside here over the next couple of trading sessions as the COMEX inventory levels have just skyrocketed. I mean, it's been remarkable. And the reason why I bring this up, last time that we saw this much delivery taking place for COMEX was COVID-19, literally the peak of COVID-19 once we started having that pullback when it comes to equity. So structurally, this looks more late cycle in nature and more mechanical in nature rather than buyers actually stepping in and saying, hey, I need to buy gold here. If you look at it on the underlying, that's not the case. Gold or crude, on the other hand, the reason why I'm bringing this one up, geopolitical risk over the weekend. So the trend has been to the downside after we kind of peaked at around $80. But do not be surprised if you actually start seeing crude oil move to the upside going into Friday because of the risk of this Gaza situation and the hostages and the comments that came out of President Trump's office here and the retaliatory measures that we could see from Saudi Arabia or some of these OPEC countries. This is actually going to be the closest thing, I would say, the closest thing that we've seen in recent times since 1973 when we had a potential, when we did have a trade embargo where OPEC stopped giving us oil. It's not going to be that aggressive, but the nature of this type of environment when it comes to geopolitical risk is really being undersold and under talked about, but something to keep on the radar here. This is not going to be something that shows demand-driven action to the upside. This is going to be more logistics and geopolitical risk premium that's going to be priced in for crude, and we'll see how it's going to settle out on Sunday.
Interesting. Appreciate it, KG. Thanks for the perspective. Like the gold analysis on the flows. Crude oil, interesting too.